You're listening to RIAcast, a podcast of the Southwest Florida Real Estate Investment Association. RIAcast brings together a variety of real estate entrepreneurs from all over the world to share tips and ideas. The core purpose of the Southwest Florida RIA is to help members become more profitable and successful through networking, education, and empowerment. Here are your hosts, Jeff Tamarello and Michael Lyons.
I am Jeff Tamburello, one of the directors of the Southwest Florida RIA, joined by the other director of the Southwest Florida RIA, the esteemed Michael Lyons, and we have Alvin. I've known you for all these years, and we work together. Taveras.
Alvin Taveras, correct.
Taveras.
Hey, did it? Yeah.
With Build to Rent, and Alvin's a smart guy. He keeps up with this space. It's a often talked about space. I crack up at how demonized it's become, that, build to rent is preventing people from owning homes. And we just put out some content that I'll put in the link to this video of, it's less than 2% of the non-homesteaded single family homes. And that really, when you take out the homestead, it really can, takes the number, and less than 2% of the non-homesteaded homes are owned by what I would call build-to-rent entities, which is what everybody associates it with. And, the Wall Street guys drop out after about 30 for the most part. And then cool part is some RIA members step in below 30. We've got a couple of RIA members that are in there. But you're looking at an interesting space. I think the space actually provides some stability to the rental market, because when market gets good and all the landlords sell that want to get out of the game, you end up with no inventory. I can tell you I've had family members rent from these big corporate entities. You do not want my son in college rented from one in Orlando, and man, it's take the worst property manager on the planet, and they're a 5-star stellar compared to it's like renting from Comcast. If you can imagine what that would be like. So, I mean, if you're going to rent from one of these entities, be prepared.
Hey, there goes our Comcast sponsorship, Jeff.
Yeah. Sorry, Comcast. It's a very interesting space, and you've got some great insights. We just had a conversation the other day, and you brought up some things that I wasn't even looking at. So I thought it'd be great to you're a speaker at the luncheon, and you are also just somebody we'd like to talk to, about this, because this is all you do, from what I can gather.
Yeah, correct. And so my background's in corporate sales, and so I've been doing that for several years. I worked at Colgate-Palmolive, MetLife, ADP, and most recently Gartner. So I'm really looking at the build-to-rent space from an investor perspective. My background was in rehabbing properties, and quite frankly, people ask me like, "Hey, so you must really love real estate?" And to be honest, I don't actually care what the vehicle is. And so if I just look at investing from like a pure logical perspective, is I actually don't care about the vehicle. If I get the returns that I need, then that's what I'm looking for. So if you look at real estate and compare it to, a stock market or any other type of investment vehicle, I got to realize, okay, what are the 4 ways that I'm building wealth in this vehicle? And so it's cash flow, of course, but it's also the debt pay down, the tax benefits, and it's the cash flow, the debt pay down, the appreciation, and the tax benefits. And so real estate is the only one that offers all 4. So in today's market, specifically in Southwest Florida, we're seeing, okay, I can't really bank on appreciation, and my cash flow is being squeezed from both, costs going up and rents going down. And so what a lot of our investors here at the RIA are going to have to evaluate is, hey, how much brain trauma do I want to get in this market where the upside isn't as bright as it was last couple of years? And so a lot of them are being asked to possibly pivot into other markets. If you understand the benefits of real estate, you have to keep deploying capital, right? There's no better vehicle than real estate. The question is where and how. And so when there's less appreciation being found in the market, the idea of trying to put sweat equity into a deal seems less promising. And there are markets that work. In today's market, the key is you got to use the right metrics to figure out which markets those are.
I mean, I was laughing. I just realized Mike eye when we put that used trailer on that lot in Georgia. Can I put build to rent developer on my LinkedIn now?
I would say yes. I would say yes. Build to rent. They didn't say build to rent what?
No, but developer. We're developers, Mike.
That's right. Well, you mentioned metrics though, Alvin. What kind of metrics do you look at for a market when you would advise someone or look at as a positive? Let's invest here. What are you looking at?
Yeah. So we're actually coming out with the build to rent market scorecard. And so we're going to be looking at a couple of metrics. And so here's the thing is when you're looking at the metrics, the common mistake is looking at what's number one and investing there. So if you look at population growth, which is a good thing you should look for, you should not invest in an area that has negative population growth. But you don't want to just pick number one, because what you're going to find is markets like Miami, you're going to find markets like Austin, and those markets right now are saturated with inventory. So if you're investing in a market that's growing, yes, has a population growth, has job growth, all that sounds good on paper. But if you look at the amount of large apartment buildings being built in those markets and the amount of saturation they have, you're in for a bloodbath. And so if you're looking at buying a single family, a duplex, or a quad, something that's more on the residential side, you're not going to be able to compete against someone building a 100-unit apartment building. And a part of the reason is they're going to be amenities rich. A single family home is an A-class property. A high-end brand new apartment building with amenities of a pool, a gym, all that is an A-class property. The difference is they're building at scale and they can offer incentives you can't. A part of that has to do with their financing. The way that a lot of these buildings are being built on bridge loans, which means they're paying interest only for the first 3 or so years. So they're trying to just stabilize the apartment building, which means they can be very incentive oriented, offering several months free, and then look to become stabilized within a 3-year time period. If you're an individual investor, you can't compete with that. Mm-hmm. So one of the big things we're looking for in the scorecard is what's saturation. So if your population growth, for example, has been at 1.3% per year, that's pretty good. But then you're also looking at, hey, how much new inventory is coming in the market? How much is currently there and how much is coming? And the problem with Southwest Florida is we have a lot already on the market and there's even more coming.
Well, and you say that bridge loan, just not to get in the weeds of the loan lending side per se, but that bridge loan and the interest only payments doesn't begin until the construction is completed and they're able to correct.
But a lot of them are 3 years afterwards. So they'll be paying just the interest for 3 years after completion until they stabilize the property. And then they'll have to start paying down the debt after 3 years. And often they'll refinance or do something else. But the point is they're looking for as much of a buffer on a cash flow perspective to basically survive that 3 years as a property gets stabilized.
Gotcha. Any concerns in the amount of apartment, for example, Southwest Florida's got a bunch going up, either both under construction or completed. Any concerns about the impact that would have on the rental market as a whole?
Yeah, it's going to be huge. It's going to be it's there's not a thing that someone can look at that say, hey, this year this number will go up. Whether it's pricing, whether it's rent, the only thing we know for sure is insurance is going to go up, right?
Yeah,
and the cost of maintenance will go up,
right? And taxes and property taxes. Yeah. Yep.
So the investor who's looking to invest in Southwest Florida, you really have to have deep pockets and you have to understand, hey, I'm going to go through some stuff over the next year and a half, maybe more, and eventually things will pan out. But if you're strictly looking at cash flow, there's better markets in Florida that offer you that cash flow without what we're going to go through over the next year. Again, we've been feeling it for about a year and a half. I think it's not widely known. I think now we're at the point where it's becoming widely known that Southwest Florida is no longer an appreciating market. Rents are declining. And you know this, Mike. So if you were making $300 a month, great. Now you're making $50. so it's just the nature of the beast. And it's not saying that it's a bad market. You just have to know what you're weighing on. So what you're weighing on is, city like Cape Coral, current population around 200K. It's going to get to 400K, right? Over the next 30 years, we're going to double in population, but there's going to be a lot of pain throughout that time period that you're going to have to withstand. And the question is, if you're looking for that appreciation where we end up being priced closer to a Sarasota or Bonita Springs, you're going to have to wait a while and go through some uncomfortable time periods with that property.
And not to focus too much on the cash flow part of it, but you mentioned that the return you had $300 is now 50. And I agree on many levels, that's so accurate. Also, I would advise someone going to buy a property, whatever the comfort zone is. It could be, I cash flow $200. I'm fine with that. I would want more than that personally, way more actually. But if your threshold's 500 or whatever it is, and you buy right, when it does fluctuate and insurance and property taxes go up and adjust, and you have expenses, as maintenance happens with houses, the bigger the buffer, the better off you are, even in somewhat of a declining market when it comes to pricing and both rental and the sales side. But again, you just got to have enough buffer in the event there's going to be a problem. And I think real estate is so exciting for so many people. They get into it, they're like, I want to buy and own property, and then if you do it wrong, it's not very exciting. So you got to have a good game plan behind it. So
well, you got to be comfortable to go through it, and this, so that's why, like, you want to go 25% down payment. I wouldn't do anything less than that. And then you want to be able to, I'm going to hold on to this property. Because again, Southwest Florida, it's an appreciated market. And so what that means is values shoot up, values come down. It's going to swing more. It's not a stable market, what it's going to be. And so that's going to work in your favor over the long run. Short term, we're going to feel some pain.
Well, we've talked a little bit, not to go on this topic very much, but we do investing in Georgia as well. And it is not an appreciation. There's no fluctuation, or very little, percentage-wise, in the values and rent rates. It's constant. So you know what you're getting into basically from the get-go, without any hope or plan of a huge appreciation. But you just know you're going to get this much return, and you're good with that, and you kind of move forward. You're right. So Southwest Florida, it's up and down, and it depends on a lot of factors that other markets aren't affected by.
Yeah, and there's markets that do work. So I mean, you want to have positive population growth. You want to see rental rates go up. You want to see incomes improving. You want to see jobs going up as well. So you want to see very low unemployment. You also want to look at markets that aren't focused on just one or two economies. So, for example, like, I would not recommend the Panhandle at all. And the reason is they're very touristy and military dependent. And so that's not a good market to be in. But there are markets closer to Central Florida that make a lot more sense. Citrus Springs, Inverness, Ocala, Sebring, where, compared to any, so those markets are growing slower than the average in Florida, but compared to anywhere else in the U.S., is growing tremendously. Florida happens to be the fastest growing state in the country, so in comparison, it's growing slower. But what they're also not seeing is a whole bunch of new construction coming in the pipeline. And so you're saying, like, hey, if I'm in some appreciating markets, I need to counteract that with some cash flowing markets, and then I get a good balance between the two.
Yeah, good. That's good.
Alvin, you talked about Austin, and Austin right now in this cycle has taken the place of where we were in relation. They're really the kind of tip of the ship going down. And I'm waiting, at some point, it's got to be a buying opportunity, because Austin's pretty cool, and they've got, I think they overbuilt to a lot of people coming. I've got people I talked to there, and one of them said, he goes, the interesting thing is all the people from California that ran the market up are now moving to Nashville. So, and so that may be an opportunity to pick something up there, because I don't know that much about Texas's laws. I'm actually starting to research because I'm thinking I'm going to grab one. But at some point, it's funny when the way the world looks at the stuff, they go, oh my God, this market's correcting. It's terrible. The contrarian in me starts paying attention. At some point, it's time to start looking. When 2009, we were never going to recover, and 20 years condo inventory, and then fast forward just a few years and it was a normal market, and you burnt through that phase of the cycle. And everybody also gets, like what you were describing of Southwest Florida with the ups and downs of the market. I've seen a lot of the investing syndicates pitching it to their buyers list as a linear market. And it kind of crack up. I'm like, Lee County, Florida is not a linear market. It is a very cyclical market.
Not anymore, at least. Yeah, maybe historically it has been, but not anymore. And a part of it is, we're on the map now. Like, Cape Coral is now the largest city in Southwest Florida. Population, it's actually the second largest city in Florida by landmass altogether. So it's on the map. People know it's here. But what is good about it is that we are kind of in that path of prosperity, where if you go a little bit further north, it's so much more expensive. You go a little bit further south, it's so much more expensive. So anything south of Venice, where you're, in Northport, in Port Charlotte, in Inglewood, in Punta Gorda, North Cape Coral, and Lehigh, you're kind of in that it's still affordable, but you have all the benefits of a premium market. It's just not filled in yet. So we're actually some of the pain point we're going through is filling in. And that's going to have peaks and valleys of supply. And again, when supply is low, we're going to all do well. When supply is high, we're going to, go through it.
Good point. Well, we're very much looking forward to your presentation and our luncheon here coming up soon. And anything else you want to add to what you've discussed thus far in preparation for that?
Yeah, so during the meeting, I'm actually going to be going through the scorecard where we evaluate some of the markets here in Florida and even add a few national as well, just to see how they rank. And I think the big part is that saying that no market is good or bad. You just have to know the pros and cons of each of them, understand what you're investing in. So depending on your investor profile and how your portfolio is made up on, you may want to be more into it being in a more appreciating market. Or you may say, hey, I actually want to take the foot off the gas a little bit and let's run to safety and be more in a cash flow market. And there's some hybrids in between, but the key is you want to understand how each market's performing and how you can play it to your advantage.
Agreed. Well, we appreciate it. Yeah, we're looking forward to, man. We will see you at the meeting, and thank you for taking the time now with us.
Yeah, absolutely.
I feel like, Mike, you should have shaved your head for this video. To be honest with you.
Next time I will.
Next video,
Mike,
you're shaving your head, Mike. We're going to shave your head on camera before the video.
Mike, I try holding on to my hair as long as I could, and
just didn't happen.
I was on your side for a while.
For a while there, that's right. Well, thanks again, man. Thank you.
This concludes this edition of RIAcast. Be sure to subscribe to receive our next episode. You can also subscribe at our website, www.swflreia.com. See you at a meeting soon. Please let us know if you have a suggestion for a future episode.